Good morning and welcome to today's webcast, 2017 Year-End State and Local Tax Update. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Thank you everyone for joining us today, and I'm going to turn the line over to Rich Croghan to get us started.
Thanks, Emily. Welcome everyone. Welcome to our 2017 year-end state and local tax update. Well, we know that there's lots of discussions out there about what's going on in D.C. and the federal tax changes. There's still a lot of uncertainty of what that final tax package will look like. And once that's clear, we'll be reaching out to this group with additional information. However, today we're going to focus on state and local tax changes in the past year. These are things that have already happened and that are already affecting our clients. Joining me today are 3 of my partners here in Moss Adams. My name is Richard Croghan. I'm a partner in our San Francisco office, and I am the industry group tax leader for the technology group, and I will be your moderator today. First up, joining me will be Anna Ferraro. She's a director in our state and local tax services group and is based out of our Sacramento office. Anna focuses on sales and use and other transaction taxes. John Clausen will be presenting on income and franchise tax updates. John is a director in our Silicon Valley office. And last but not least is Mark Hawkins, who will be presenting on income and franchise tax updates and also how the Federal Tax Cut Act may impact state taxes. Our agenda is fairly straightforward. We're going to talk about some income and franchise taxes across a number of states. Each state, as you know, enact their own laws, have their own regulations. So we'll address a bunch of those changes. Anna will talk about sales and use tax changes that we should be aware of. And then lastly, because of all the discussion about the Federal Tax Cut Act, we should all have some understanding of how that may or may not impact state tax calculations. We won't cover every change in state laws. We simply wouldn't have enough time to cover everything. But we will cover the changes that are most likely to impact technology, communication, and life science companies. As mentioned in the introduction, participants will need to complete the 4 polling questions in order to receive the CPE credit. Our first polling question, an easy one, and I just messed up. How closely do you follow state tax changes? I assume you're here because you're not following it all that closely, but we just want to kind of level set to make sure we understand the audience. Are you covering these changes a lot, a little, or not at all? So give everyone a little bit of time to respond so you get the credit. And also, as another reminder, if you have any questions going along, I'll make sure you submit your questions through the Q&A function. All right, with that, we're going to close up the poll and move to the results. All right, so about 70% of you followed a little. That's kind of what we expected. We assumed if you're following it a lot, then we'd have to up our game a bit. But what we're doing is we're spreading kind of the general information out. And if there's any other specific questions, feel free to ask through the Q&A function or follow up with any of us here today. With that, the first item on the agenda is the state income and franchise tax update. And with that, I'm going to turn it over to John Clausen. John?
Thank you, Rich, and good morning, everyone. I will be discussing some of the changes that have happened in the world of state income and franchise taxes. And first off, I'm going to talk about some of the trends that probably many of you have seen and are aware of happening across the country in the various states that impose taxes. The first one in general is that the states are finding new ways to assert that businesses have established Nexus in their state for income and franchise tax purposes. And probably one of the more far-reaching ways that they're doing that is by saying that a company that has a certain amount of sales that are destined for a state, once they cross a certain threshold, and we'll have a slide that shows the thresholds and the various states that have enacted these types of rules. But once the business reaches a certain threshold of sales into a state, then it is deemed to have Nexus in that state. California actually is one of the states that has enacted that law now. It's been a while that's been effective since 2011. That first took effect at approximately at 500,000 of sales, but it's indexed for inflation, and so now it's up to I believe it's 544,000 now for California purposes. So there are some that are indexed and some that are not, and there are different thresholds. But that's good to be aware of the trend, because it's something that should be checked every year. Okay, is there a new state that has this threshold, and do I cross it? Do I have a filing requirement? Another significant change and trend that we're seeing is involving the way that businesses are required to apportion income in the states. So the apportionment rules generally come into effect for multi-state businesses that are doing business in more than one state. They have a filing requirement in more than one state, and once that happens, typically the states will require that companies apportion their income using a formula. And for a long time, most states had a 3-factor formula that used property, payroll, and sales in the state as a percentage of those factors everywhere, and then took the average, and that became your apportionment factor. Well, more and more states are getting rid of the property and payroll factor as part of the formula, and they're just looking at the percentage of sales that a business has in the state as a way to apportion the income. I think that many states see that as favorable for companies that want to have property, that want to have a plant or significant investments in a state. They want to make the rules more favorable to those companies, and it also helps them capture a greater percentage of the out-of-state businesses that have most of their property and payroll out of the state. So that's been a popular trend for states. And lastly, the states are using a different approach, what we refer to as market-based sourcing, for determining that sales factor. For a long time, the majority rule was what we called the cost of performance rule, that looked at where the activities were performed in providing a service. And under the market sourcing rules, the location of where the activities occur is not important. What matters is where is the customer, where is the benefit of the service received. So that's also the third major trend. So as I mentioned, the factor presence nexus, which is the threshold of sales at which a state will impose or assert nexus on a company, these are the states that currently have enacted those types of rules. And you can see California has an odd number of 547. As I mentioned, that's because it's indexed for inflation, and that will go up each year a few percentage points. And the other ones, the most common threshold is 500,000, but New York is at $1 million, and Michigan is at 350, and Washington has the lowest threshold, which is for its B&O tax, or business and occupations tax, at 267,000. Tennessee is the newest member of this club with its $500,000 threshold, and an interesting point for Tennessee is that Tennessee has a net worth tax that is not protected by the federal law, which we call Public Law 86-272. So if all that a company is doing is selling tangible property into Tennessee, the Public Law 86-272 prohibits Tennessee from imposing its income tax on a company solely because of sales of tangible property, but there is no prohibition against Tennessee imposing its net worth tax. So those companies that are only selling tangible property need to be aware that Tennessee could assert nexus and impose its net worth tax once the company exceeds that $500,000 sales threshold into the state. The next slide, this slide does show the states that have moved to the single sales factor approach for apportioning income. And down at the bottom, I just wanted to point out that the very last note there for North Carolina should say for tax years beginning after December 31st of 2017. And so there's 21 states here now, so that is approximately half, a little under half of the states that impose income taxes are now single sales factor states. So the importance of payroll and property in the computation of state income taxes has diminished over time. There are still some states that take those factors into account, but by far, the most important factor is the sales factor, and that continues. The trend continues. This next chart shows the current population of states that use a market-based approach to determining the sales factor. Again, there are 21 states here. And one thing to point out here is that market-based sourcing is not applied similarly across all of these states. So there are some states like California that says the market is where the benefit of a service is received. And other states will say, well, it's where a service is delivered. And so there is some gray area here in terms of determining where the market for services or for licensed intangibles should be. And that's just something to be aware of if your business is comprised of service revenues, that you can't just assume that the location of the customer is the location where the market-based sourcing rules would say the revenue should be sourced. The customer may be benefiting in all of the places where the customer does business. And so some states will look beyond just the location of the customer, and they'll look at the location of the customer's customers. And other states may not, and it does get into becoming a facts and circumstances-based analysis when you really get into the nitty-gritty of these state rules. So this is an area where we spend a lot of time helping clients, and can get complicated. So this next slide is something that came down in California in 2017 that really gets to that topic of, where do I stop? Do I stop at the location of my customer to determine where to source a service revenue, or do I look through to the location of my customer's customers? And California regulations on market sourcing didn't really address whether or not a service would be considered to be should be sourced to the location of the customer, or whether there'd be that look through to the customer's customers. But they did have some rules that helped determine the location of revenues relating to the licensing of intangibles. And so California has taken the approach that a similar categorization of service revenues should happen to determine where to source service revenues. So the first step is to determine, is a service a marketing service or a non-marketing service? So, for example, if I'm a SaaS company and I develop software that helps my customers sell their products or services to their customers, that would be a marketing service that I'm providing to my customers. And therefore, for sourcing my revenue, I should look through to the ultimate location of my customer's customers. And sometimes this is going to require what we call a reasonable approximation. You may not have all of the information necessary to know where the ultimate customers are. And the rules do, in many states, allow for an approximation. Other states might just skip straight to billing address if you don't have the ability to make an approximation. So again, these rules have added a fair amount of complexity to sourcing revenues. If you're not providing a marketing type service, then you don't look through. You just stop at the location of your customer. And this was consistent with an earlier ruling that came to a similar conclusion for sourcing of service revenues in California. So what about companies that don't have any receipts in California and they're doing business in multiple states, so they're required to apportion income, but they're a startup business, so they're not generating any revenues yet, but they're generating a lot of expenses and losses, and they're required to apportion. And using the single sales factor formula, if you don't have any revenues, California's position is that zero revenues means zero apportionment. Even though a mathematician might say 0 over 0 is an undefined number, California says 0 over 0 is 0. So in this situation, California has actually recommended that taxpayers submit a petition to the Franchise Tax Board asking for a better result than 0, because they recognize that this is a problem for startup companies. In October of 2016, in the FTB's Tax News article, they suggested that companies that are startups that have no receipts should submit a petition asking for relief and asking for an alternative method of apportioning those losses that they have in their startup years. Another significant update that happened in California during 2017 was that the state issued what is called a Technical Advice Memorandum, or a TAM. The number of that is 2017-03. And it basically provided guidance on how California applies the Internal Revenue Code Section 382 rules that limit the ability to deduct losses after a change in ownership. So for federal purposes, there have been long-standing rules meant to discourage and limit the trafficking of NOLs or tax attributes in business. And so those rules generally define a change in ownership as a 50% or more change in the ownership of a 5% shareholder. And California conforms to that definition. But it was never really spelled out whether California would require the federal limitation to be apportioned or whether California would just pick up the federal limitation. And this TAM clarifies that California does just pick up the federal limitation on a pre-apportionment basis. So you do not have to apportion that federal limitation when you're considering how much NOL you can deduct in California following an ownership change. Another ruling that came down in California in 2017 was a Chief Counsel ruling, again 2017-03. And this one involves a rule in California that we call the substantial and occasional sale rule. The site, for those of you that like tax sites, is California Regulation 25137 C1A. But this California regulation kicks out from the sales factor sales of large sales that are considered substantial and occasional. So you need to meet both tests, or maybe better said, if both tests are met, then the sale is kicked out of the factor. And that can, have a big impact on a sales factor if it's a large transaction. Probably the most significant fact in this ruling was that there were 4 similar types of divestitures that had happened over an 8-year period. And the last similar type of ruling that came down from California was a ruling called the Appeal of Triangle, which involved 3 transactions over a 4-year period. So, and the ruling said that the 4 transactions were still occasional. So I think what we can take from this is that, it's likely that if you only have a few transactions, 3, 4, probably even 5 or 6 over a multi-year period, that's still not enough to be considered frequent, and you would still be occasional and likely have to kick out the sales from your factor. Now, a Chief Counsel ruling is not, the highest law of the land, so this position could be challenged, and there may be some authorities from other states that a taxpayer could incorporate into an argument. But this does provide guidance on the state's point of view with regard to a particular fact pattern. So with that, I'm going to pass it over to my colleague Mark Hawkins to discuss some other state changes that happened in 2017.
Thanks, John. So the slides that I'm going to discuss are going to address more of legislative and case law changes that have occurred in all the rest of the states besides California. Starting off, the Oregon legislature passed Senate Bill 28. And Senate Bill 28 is important because this is the legislation where Oregon transitions from being a cost performance state to a market sourcing state. In other words, Oregon is going effective January 1st, 2018, will stop sourcing service and intangible revenue based on the cost of performance and now to the location where the service is delivered. It appears likely that Oregon, in giving clarity to their market sourcing rules, is going to adopt the MTC draft regulations very soon. So we should have additional clarity as to how Oregon intends to apply its market sourcing rule. We do know, however, that as part of the legislation, taxpayers are going to be permitted to do a reasonable approximation in sourcing out their service revenue, similar to what can occur in the state of California. In addition, Oregon is going to narrow its definition of sales for purposes of determining the sales factor. Previously, the term sales included all of a taxpayer's gross receipts that contributed to the production of business income, so a very broad definition. That definition is now being narrowed to, in essence, only include those gross receipts that are derived from transactions and activity that occur in the taxpayer's regular course of business. So what the legislature is trying to do here is statutorily exclude all gross receipts from one-time sales. In addition, the Oregon Department of Revenue has lost some business, non-business cases, and the legislature has responded by broadening out the definition of income that can be apportioned, moving to an apportionable income versus non-apportionable income dichotomy, where in essence the legislation says that all income that can possibly be apportioned under the U.S. Constitution will be apportioned to, or will be subject to Oregon apportionment rules rather than direct allocation. Montana is another state that, very similar to Oregon, adopted market sourcing. In House Bill 511, Montana also moved to sourcing revenue based on the location where the service is delivered, rather than location of the income-producing activity measured by the performance costs. Again, it is likely that Montana will adopt the MTC draft regulations in giving clarity as to how Montana is going to apply its market sourcing rules. These rules are effective starting January 1st, 2018, and similar to Oregon, Montana has also significantly narrowed its definition of sales in computing the sales factor, such that only gross receipts from transactions and activity received in the ordinary course of business would be included in the sales factor, and thereby excluding significant gross receipts from one-time transactions. Montana's market sourcing rule, unlike Oregon's, has a provision to watch out for, in that it's a throw-out rule. That under Montana's market sourcing language, if the taxpayer is sourcing service receipts or intangible receipts to a location where the taxpayer is not taxable, then Montana would require those gross receipts to be removed from the Montana sales factor denominator. That would have a corresponding increase in the taxpayer's Montana sales factor percentage. Moving on to other states, one area where that has generated a lot of uncertainty are those states that have not moved to market sourcing and still source service revenue based on the location where the service is performed, or using the income-producing activity / cost of performance approach. In many of these states, we're seeing departments of revenue on audit or in litigation seeking to impose a market sourcing standard on a taxpayer, notwithstanding the regular statutory language that would source services more based on an origin-based location. In Texas, there is a comptroller's ruling where the taxpayer was performing risk and fraud protection services for clients, and the services were all occurring in the state of Texas, and the servers were located in the state of Texas. But the taxpayer sought a ruling with the comptroller's office attempting to source its revenue based on customer location. And the comptroller agreed. The comptroller's office focused on what's called the In-Product Act, that the service that the customer was contracting, the computer-related service the customer was contracting for, was, in Texas' mind, performed in the customer location when they downloaded the relevant data. And so in this case, it was a positive result for a Texas-based taxpayer, because they were able to export their service revenue to their customer location instead of sourcing it all to Texas. In Virginia, a similar ruling was sought by a taxpayer, but in this case, the Virginia Department of Taxation held that the statute says that you source service revenue to the location of the income-producing activity, and in this case, the income-producing activity was almost all in the state of Virginia. And so the taxpayer was not able to export its service revenue all across the country that it would have been able to had the Revenue Authority adopted more of a market sourcing approach administratively. South Carolina, there was a case that involved DirecTV where DirecTV sought to source the income-producing activity really to the location where it built out its overall satellite distribution network, which was mostly outside of South Carolina. South Carolina, in turn, argued that the relevant location of the income-producing activity was the place of activity. In other words, the customer location. And this case went all the way up to the South Carolina Supreme Court, and the South Carolina Supreme Court agreed with the Department of Revenue's position that the relevant income-producing activity in these transactions was occurring at the customer location when the customer transacted for the satellite TV distribution service. Really, this focuses on a distinction between more of an operational approach or transactional approach. A state that focuses on an operational approach for cost performance is more likely to source the service receipts to the location where the taxpayer has built up its service providing infrastructure. Conversely, states that have adopted more of a transactional approach in defining the relevant income producing activity are going to source receipts to customer location. Finally, there is actually a taxpayer win in the state of Indiana. Indiana, like South Carolina, had sought to impose administratively a market sourcing result on service providers. In this case, this taxpayer involved an online education company that had built out their online distribution outside of Indiana, their online distribution network outside of Indiana. The Department of Revenue sought to source the service revenue to Indiana customer location, and the tax court found that there was no statutory support for the Indiana Department of Revenue's position, that Indiana sourced service revenue to the location of the income-producing activity, and in this case, such activity was outside of Indiana, and in the absence of the Indiana legislature adopting market sourcing, the Indiana Department of Revenue could not impose such a result administratively. So you can see that the litigation on this is mixed and creates a lot of uncertainty, which in turn creates risk for a multi-state taxpayer. And then finally, there's a fairly important case that recently came out in the Commonwealth of Pennsylvania that involved the statutory cap on net operating losses. Pennsylvania imposes a cap on NOLs, which is the greater of either $5 million or 30% of taxable income. Nextel had sought to have these caps held to be unconstitutional under the Pennsylvania Constitution because the Pennsylvania Constitution requires uniformity of application of tax in rates. And the Pennsylvania Supreme Court agreed with Nextel insofar as the $5 million cap was concerned, but refused to strike the entire cap. And the result is actually a very taxpayer-adverse decision where they can no longer claim an NOL up to $5 million, even if that $5 million is now much more in excess of 30% of taxable income in the current year. So now we're going to move on to our second knowledge check.
All right, thanks, Mark. So, again, this is for CPE purposes, and just kind of following on the sales, single sales factor trend. How many states do you have customers in? 1, less than 10, about 20, or all of them? This may dictate how many states you have Nexus in. If the states have Nexus, or if you already have Nexus for whatever reason, how many states might apportion some of your income. But before we let people answer, John or Mark, a question came in. Are these market-based sourcing rules, do they apply the same to goods and services?
Sure, thanks, Rich. I'll take that. They do not, actually. So the market-sourced rules are generally targeted at services and sales other than sales of tangible property. Sales of tangible property generally fall within other rules, which the most common rule is the ultimate destination rule, which in many cases would get you to a similar place as market, but they're more focused on delivery of the goods for tangible products, whereas the market sourcing rules get into where the benefit of a service or the use of an intangible occurs. And the rules for the goods don't get into that kind of an analysis.
All right. Thanks, John. And one other just comment that sometimes comes to me, and especially working with technology companies, is that we're in a loss position. Why do we care? Well, companies may want to care because hopefully they're not always going to be in a loss situation, and it's helpful to have those losses built up in these states where ultimately they'll need to pay taxes. So with that, it looks like a broad mix. There's a few that just are solely in one state, so that keeps things kind of simple. But once you get out of that one state, and even if you just have operations in one state, you can often trigger Nexus in other states. But with that, I'm going to move it on to the next part of the agenda, this 2017 sales and use tax update, and I'll turn it over to Anna. Anna, a question came in a little while ago about whether or not the Nexus standards are the same for income tax and sales tax, and I'm hoping that you'll be able to address this here. So,
definitely will. Thank you, Rich. So they are not. Sales tax is very much a physical presence standard. It's a bright line test that was set under a U.S. Supreme Court back in 1992 called Quill. The states are trying to push on that Nexus standard, but as of right now, physical presence is the key. So physical presence is having an independent contractor, an employee, inventory, fulfillment services where the company requires you to place their inventory in various warehouses throughout the U.S. does create Nexus. Having an office location, those are physical presence, and they would create they will create physical presence and require a company to register for sales and use tax in the 46 states, including District of Columbia, that do impose a sales and use tax. However, states are they're frustrated with the physical presence because of internet sales, and they continue to try to push on changing that rule or trying to expand it or reinterpret it. Affiliate Nexus is one of those reinterpretations of physical presence. So they're still playing off the whole physical presence in that, okay, you're going to make sales in my state. Let's see how we can call this a physical presence. So under Affiliate Nexus, there were a couple of concepts. One was that if you had a related entity, and related is along the lines of ownership. So if there's some type of similar ownership between an in-state and an out-of-state retailer, and that percentage varies dramatically from state to state. I've seen it as low as 10%. I've seen it as high as 50 to 80%. But anytime you have, whether it's a brother, sister, or parent, any type of relationship, ownership interest where there's an in-state entity that's doing business and you're selling into that state, you do need to look at whether or not that in-state entity is creating nexus for you in the state. Other factors that are looked at for this affiliate nexus is whether or not similar products are sold not between the entity, but if the in-state entity sells a similar product that the out-of-state entity does, if there's similar trademarks, trade names being used. All those are factors that the states take into consideration and determine whether or not you may have created affiliate nexus in their state. The other aspect of affiliate nexus is what's referred to as click-through nexus. And that generally refers to, it was basically when you have a blogger or someone in the state who maybe puts a link to a retailer's website on their blog. We see it a lot with the schools. I know my children's schools do it all the time. If you do your shopping by clicking through the link on our website, any sales you make, the school or the blogger gets a certain percentage back. So in those situations, if there's an in-state person, there actually has to be a sale made by use of that link, and that person in-state has to be receiving a commission before a nexus is created. And usually there's also dollar thresholds as well. So a small blogger or such is not going to create nexus, but if you have a lot of sales that are generated in that fashion, that can definitely create physical presence or their interpretation of physical presence in the state. Unfortunately, affiliate nexus has been upheld at the state level. New York was the first state to impose that concept, and I believe it was Amazon and probably Overstock challenged the law, ran it through the courts, and New York Supreme Court eventually came back and said, hey, it's fine. U.S. Supreme Court refused to hear the case, so they left it standing on that aspect. The next line, or the next attempt, most recent attempt, and that has occurred this year, is what's referred to as cookie nexus, and it's not as good as it sounds. It is the use, or this was Massachusetts, they basically said the use of in-state software, so an app, whether it's you're downloading the app on your computer, an app on your phone, but if you have people in-state that are downloading your app and using it, Massachusetts says, hey, that's a physical presence. You have something that is physically located in our state, and it is creating nexus. Additionally, ancillary data such as cookies. So when you go to a retailer's website and you start looking around, and it puts cookies on your computer to mark certain things that you've looked at to bring you back and remind you. Massachusetts is also saying that creates a physical presence, and therefore they want retailers to start registering a state and collecting tax. Now, this is a recent rule that happened probably in the fall. The thing with all these new nexus trends outside the affiliate nexus, the cookie and the other two items we'll be talking about are the economic nexus as we go forward, is you have to realize that states are going to some extent, some may aggressively enforce these, some are hoping it's just going to encourage you, but you have to take it seriously and look at it from a business point of view and make a decision of, hey, what's the risk that I'm going to get caught by a state, and if so, what dollars are we looking at here? So Massachusetts passed that. Connecticut has proposed legislation along the lines of cookie nexus, and someone in Massachusetts has challenged the rule, so that will be going through the court system. However, what we're seeing is the states want you to challenge these rules. They're hoping to eventually get something back in front of the U.S. Supreme Court that will change that bright line standard of physical presence. So the next trend is then economic nexus, and this was discussed on the income tax side since it's a concept that has been prevalent in income tax for a while. Now, economic nexus completely goes against the physical presence. There's absolutely no physical presence required. This is just a retailer directing their sales to an in-state customer. Alabama began this trend back in 2016 and said, hey, you know what, we're getting tired of people not registering. We're losing out on all use tax. We want our tax. We're going to say that if you have sales of $250,000 or more into our state in the prior year, you have Nexus with our state and you need to register. Alabama has been enforcing this, and Alabama's law is being challenged currently. Obviously, these take a while to go through the court system. But I think part of it is the state's just hoping that enough people come forward and register and realize it's not a big deal to register and pay tax, that they're still going to come out ahead even if they do end up losing down the road on this economic nexus. However, they do have some copycats. So South Dakota said, hey, I like that idea. Let's do the same thing. They came in and they said if you have sales of $100,000 in the last year, or if you have 200 or more separate transactions to customers into our state in the last year, then you have Nexus with our state and you're required to register. Now, South Dakota put enforcement of the law on hold while the constitutionality of the law is being decided through the courts. However, South Dakota also fast-tracked it in that any challenges to their law had to go directly to the South Dakota Supreme Court, which it has, and the South Dakota Supreme Court has struck down the law and said it was unconstitutional. However, South Dakota wanted that because they want this going up to the U.S. Supreme Court. So they are petitioning the U.S. Supreme Court, and they're hoping the U.S. Supreme Court will take this case and change that physical presence nexus standard. This is a list of states as of I think it was about July or August that have some sort of economic nexus rules. Keep in mind each state has different thresholds on dollar amount, number of transactions and such. But be aware that other states are copying what Alabama and South Dakota have done and hoping to get along. This is a list of states that have those affiliate nexus rules. Now, when they do these affiliate nexus rules, some of them have both the ownership interest and the click-through. Some have one, some have the other. The ownership interest percentages change from state to state. Some states like Arizona, they didn't pass a law. It's just an interpretation. So it's a legal ruling about affiliate nexus and how it applies to you. So be aware of all these states. It's a big chunk of them. Reporting requirements. So Colorado said, heck with this nexus thing. We're tired of fighting people over whether or not you have nexus. So we're just going to say, even if you don't have nexus in your state, if you're a retailer making sales into our state, you are required to send us information and provide information to your customers about their responsibility to self-report and remit the use tax. So this law actually was passed back in 2010, I believe, but it was challenged to the courts, federal courts and such. And eventually Colorado won, unfortunately. And the courts came back and said, you know what, Colorado is not imposing any unfair burden on out-of-state companies because they require their in-state companies to report, obviously, as they're registered for sales tax. Thus, Colorado put this law into effect. They negotiated an effective date of July 1st of 2017. And under these reporting requirements, a retailer who's making sales into the state of Colorado has to, number one, on each of their invoices to their customer, let the customer know that the purchase may be subject to Colorado use tax and that it is the purchaser's responsibility to self-report and remit that use tax. The second thing they need to do is at the end of the year, they need to provide a report to each customer, hey, this is what you purchased over the year, this is how much it is, this is what you bought. By the way, you're responsible for self-reporting use tax to the state of Colorado. The third third report that is required in those reporting requirements is that the retailer also has to send a report to the Colorado Department of Revenue saying, hey, these are the people who purchased items from us during the year. This is what they bought. This is the total. And the idea is that, in theory, that Colorado is going to take this information, go back and start looking at people and say, hey, you bought this, you didn't self-report. These requirements come with penalties, and that's where the big bite comes in, because most people are going to say, yeah, you know, I don't have Nexus, I don't have a requirement, what do I care? The big issue was the penalties and whether or not Colorado could impose them, and they can. So every time a retailer leaves the information off the invoice about reporting use tax, it's a $5 penalty. Every time they don't send an annual report to a customer, it is a $10 penalty. And every customer left off the annual report due to the state is also a $10 penalty. So it gets to the point where the penalties can add up significantly, and a lot of people have decided it's just not worth, it's easier to collect and remit sales tax reports to the state than deal with these reporting requirements. Again, we're assuming Colorado is going to enforce this. Obviously, the last thing Colorado wants is a ton of information they probably cannot handle. So again, they are hoping that you'll turn around and voluntarily register. Other states have seen Colorado's success, and so they are passing similar laws. Some have penalties, some have not, but they're basically saying, hey, we want you to report. And they're all along the similar lines in that you have to let the customer know that they may owe you tax. A lot of them want you to notify the state about certain information, and there's certain notices that have to be sent via mail in certain via first-class mail and have certain font size and such. It's getting into a lot of those legal requirements. So again, they're hoping that they're encouraging you to register with the state and voluntarily collect and remit sales tax. Next is digital products, and we're going to go a little fast on this, so if you have any questions, go ahead and send them in and we'll respond to those. But the other issue, obviously, is software, digital products, services, software as a service. So when you're looking at software and software as a service and trying to determine the taxability of an estate, there are many aspects that have to be reviewed. The state's definitions are not uniform, so you have to look at, is this software being downloaded? Is it being remotely accessed? Is there a little bit of it that gets downloaded, even though the majority of it is accessed remotely? The states may tax a digital product, such as an ebook or music or video that's downloaded where they normally did not, or they may look at it as a digital service or data processing. So when looking at a software, you have to look at what the software is doing, what is it accomplishing, because that's going to determine whether or not a state's going to say, hey, it truly is software that's downloaded. It's SaaS, software as a service, or maybe it's infrastructure as a service, or platform as a service, because some states will tax the SaaS, but not the infrastructure as a service. And then also states also have numerous definitions, so they may tax numerous services, and the definition of SaaS doesn't fall under the definition of a software, and you're like, hey, I'm home free. But if you look at other states, such as Texas, they define data processing services and information services as taxable. A lot of accounting software tends to fall under that data processing services or information services, and that's also subject to tax. Also, what can affect the taxability of software is whether or not any aspect of it is ever transferred via tangible personal property. In California, the transfer of a dongle, as minor as it is, and even though the software is downloaded, will create a taxable transaction, whereas pure electronic delivery of the software is considered service and not subject to tax. Also in California, we're still dealing with what we refer to as the TTA, the Technology Transfer Agreement, which looks at it as it's not really a tangible item that is being transferred, rather it is an intellectual right or property. So there were a couple of cases that came down a few years ago, and California is still fighting. They're not fighting the court cases; they're fighting the administration of the concept. But anytime you have an agreement where the seller holds a patent or copyright and assigns or licenses the right to use that patent or copyright to make or sell a product under the court cases of Lucent and Nortel, that is an exempt transaction, whether there is any tangible personal property involved or not. That's still an evolving issue in California on the administrative side. I do apologize. I know we're flying through this. Lastly, the updates. Certain updates were made to the R&D and manufacturer partial exemption. One of the big ones on that, and R&D and the manufacturing exemption is defined by NAICS codes. So the entity itself does not have to fit into one of those NAICS codes. It's rather the activity that's being done. So you can have someone who is not really doing that may be doing something completely different. But if you have activities, R&D activities, and you can separate those out via division, a location, some type of separate accounting, you can qualify for this partial exemption. And what it qualifies is you could get the equipment, tooling, so computers, servers, any type of equipment, tooling, anything with a useful life of at least 1 year would qualify for the exemption if used in that qualified R&D or manufacturing activity. One of the big changes that occurred this year is that the Board of Equalization, now referred to as the California Department of Tax and Fee Administration, had been holding that if you did not actually capitalize the item, even if it had a useful life of at least 1 year, they were not allowing the exemption to go through. However, they have since, this legislation backtracks on that and requires that the Board of or the CDTFA allow those types of items to qualify. So if you have been under audit, if you were assessed tax, or you just failed to claim the partial exemption on anything that is used in this qualified activity that has a useful life of at least 1 year, you have until June 30th of 2018 to claim a refund on those items. The rule is going to be effective going forward. They just limit the refunds to June 30th of 2018. And I think
all right,
on to
Anna,
the
thanks.
question.
Yep. Now, next polling question again for CPE credit. Where do you think you have the most potential exposure? Income franchise, sales or use, or some other state tax? We've got a lot of questions in. We haven't got to them. We haven't spoken about all of them. We've responded to some individually. What we will do is we'll collect the questions and then try to send up as part of the follow-up. So everyone submit their answers. We can touch base on the state and federal tax reform real quick. Mark, you have about a minute to go over it. I apologize. There's too much great information. All right. Oh, I don't know what happened to the results. All right, sales and use tax is a big area. Okay, other developments. So, Mark, why don't you kind of take it here and do a quick overview?
Yes. So we are expecting the Congress to pass some portion of federal tax reform in the coming month, and this can have a very significant impact to state taxation. As you can see from the map, states are in essence divided into two camps. Those states that automatically conform to the Internal Revenue Code to whatever changes Congress makes, or states that have conformed to the Internal Revenue Code as of a specified date, such as January 1st, 2017. Those states that conform to the IRC as of a specified date will not automatically conform to whatever tax changes Congress would enact this month, and would have to affirmatively elect to adopt certain changes when they go into session. Just some examples of...
Just, Mark, real quick, just for people there, the states that in blue are those that automatically follow. The states in the red are as of a fixed date.
Yes. So just some examples of what we could see happen with the changes to the tax code and how that might impact the states. If Congress goes to full expensing, then the states that have not automatically conformed to the Internal Revenue Code will not automatically conform to full expensing. But in most cases, many states such as California and Illinois and Pennsylvania just have not conformed to bonus depreciation since it first came out in 2003. So this might not have that much of an impact. What we could see a significant impact on is elevating the expense limit for Section 179 to $5 million. Many more states conform directly to 179 than others. Bonus
all right, Mark.
depreciation.
Just in interest of time, I got to jump in. There are a number of these impacts that are to consider, but we need to get to the last polling question. Do you know if your state conforms with federal tax law? Obviously, we just had the map. You can cheat. Give everyone a chance to answer another polling question to get their CPE credit, and then we will wrap it up. I'll give everyone another 15 or 20 seconds. Again, if there's any other questions that you had, you can submit them to the G&A or the Q&A process. Yeah, you'll have all our contact information. Don't hesitate to reach out. So with that, all right. About a third of you know whether your state conforms. The rest of you are sure that they don't, or you don't know. So it's a mix. But with that, I think we need to wrap up for the day. Appreciate everyone's attendance. I know there's a lot of information, a lot going on. We could talk for hours on this, and probably lose some of you after the first hour. But anyway, here's all our contact information. And with that, I'm going to turn it back over to Emily for the last bit of housekeeping.
All right. Thank you, Rich, and thank you, Anna, John, and Mark, for a great presentation today. Again, we certainly covered a lot of information. If you still have questions, please feel free to reach out to any of our speakers, or the console will still be open for a few moments if you'd like to enter a question in there, and we can follow up after the presentation. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of your slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window, also to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.